Welcome back to another video. Thanks for tuning in. This time we've got something a little different. We're doing a full breakdown of one of the trades I took this month as part of a very successful trading month for January 2025, where I hit an 83% win rate over 6 trades and achieved another payout on my futures funded account. Stick around because I'll share more about that at the end of the video. But first, let's break down the trade. Firstly, let's talk about my trading window. I typically trade between 8 AM and 11 AM GMT, and then again from 1 PM to 4 PM GMT. If a setup doesn't play out within these time frames, I don't take the trade. This time window came from my backtesting, and it's been extremely profitable over the last 6 months. Plus, it allows me to hit the gym or take care of other work in between sessions. Trading all day long, that increases your chances of making impulsive decisions and giving back profits. Trust me on that one. So, my strategy, simple but effective. I focus on 2 main time frames, 15-minute and the 5-minute chart. So here's how I break down my trades using 3 simple rules. Liquidity grab, marking key levels, and entering on the closure of a 5-minute candle. First, I wait for a significant liquidity grab on the 15-minute chart. Now you might be wondering, what does liquidity mean in trading? Essentially, liquidity refers to the amount of buy or sell orders in a particular price range. A liquidity grab happens when price sweeps through these areas, often targeting equal highs or lows, or taking out the day's key high or low. This is where the big moves tend to happen, and it signals a potential reversal or continuation. So, when I came to my charts on Friday the 24th of January, I noticed that during Asian session, equal highs were created, and that was right here. This may have been noticed in the London session, but there wasn't anything happened in the London session, so I left that session, went about my day, done my thing, and came back at 1 PM. And the highs of the equal highs of the Asian session had not been taken yet, so I was looking for price to take these highs and potentially see a reversal. And at 2:45 PM this happened, and this then took me on to the second rule of my strategy, which was marking a key level. So once I see a liquidity grab, the next step is to mark out a key level. This could be a strong support or resistance zone, or areas where price has reversed before. I'll look for wicks or price rejection at these levels. After marking it on the 15-minute chart, I zoom into the 5-minute chart to adjust the level and refine my entry. So once the liquidity grab had taken place, you're looking for a reversal, and when that reversal starts to happen, I start to look for a key level. So you could enter aggressively right here. As you can see, we've got a quite clear rejection where price has rejected and then closed back above this level here and pushed higher. So once price closes below, that could spark a reversal, which it did actually happen, where you can see price did start to push down, and then we pushed back up to that level and continued lower. But for me, that's too aggressive for me. I like to see multiple rejection zones. So I moved my key level down to here, where you can see we've had multiple rejections or support zones where price has then pushed higher. So we've got one here, multiple there. You got price going back and forth between this level, and then you have another level here where we pushed and broke this high, another level here where we pushed and broke this high. So for me, if we then close below here, that for me is the real sign that price is going to continue lower. And of course, because we're entering a trade on the 5-minute, it just makes sense to adjust your level on the 5-minute. So therefore, I would switch to the 5, and by adjust I mean I look for get rid of these rejections. I look to adjust my level. As you can see here, the level is not quite below the 5-minute support, so I would adjust that right there, and then I'll just move across to make sure that we're below any other support levels. And right here you can see again got to adjust it there, got to move it there to adjust there, and now you can see we're below all the levels. Yes, we are below every single level here. So therefore, if we have a closure below this level right here, once we have adjusted that on the 5 minute, I then move on to my next rule. Rule number 3, I only enter after the closure of a candle. This is really important for me. The closure confirms that price is actually reversing. Whether you call it a breaker structure, change of character, or whatever else, a candle closing above or below a key level gives me that confirmation that price wants to move in a specific direction. Sometimes price will look like it's closing, then it reverses, leaving just a wick. So if we use an example of this wick rejection, here you can see that price, here you can see quite a key level where price has rejected from numerous times. Here, here, here where it's pushed higher, closed below here, gone lower, closed the back above, gone higher. So as you can see, so theoretically, if we take this high here and then we push down and close below, you would expect price to push lower. But what happened is we took liquidity here and then we whipped into it, and at one point you could see the candle would be full and it would look like it's about to close. So if you got FOMO and wanted to enter when the candle was below this level, what would have happened is you would have been faked out and price would then continue higher, stopping you out if you put stops above this high, depending on what you prefer. So that for me is what I'm trying to avoid. And as you can see from this, we had multiple rejections of this key level that I had marked up. So when I was watching this live, I had an alert set below here. So whenever price came below it, my alert would come, and if I was away from my desk, I would come back to my desk and watch price until the 5 minute candle closed. As you can see, if I had entered multiple times, there was a potential for price to come down, look full here, and it looked like it's going to continue to push lower, and I get FOMO, I want to enter, and then before you know it, price had just pushed back up and I'm in drawdown now. So for me, closure below is so important, guys. It really gives you the confidence that it is then going to work, because what you don't want to do is enter and then you don't have that confirmation and price is just around here, and you know that from back testing that closures below work, and you often see reversals. So when you're in one where there's no closure below, it's a bad place to be in. You do not want to be in that. So I always wait for a closure below the key level. Now as for my target, I always go for a 1-to-1 RR. I've been trading this strategy for over a year now, and it's consistently worked well for me. This setup has passed multiple funded accounts, and after back testing on different pairs, I found 1 RR to be the sweet spot. I did try going for 2 RR during back testing, and that worked great, but in live trading, it didn't suit my psychology. I found myself constantly moving stops to break even, only to get stopped out and left with nothing. And when you're trying to pass an evaluation, getting stopped out and left with nothing after being up $500 isn't a great feeling, compounded by the fact that you could then potentially take a loss and all of a sudden you're down when you were up. It didn't sit well with me, and with going for 2 RR, you of course have less wins, and when you have less wins, you're obviously not going to get closer to your target that you need to get to on your evaluation. So for me, 1 RR was perfect, because if you rack up a few wins in a row, as I have done this month, it really adds to your profit and it gets you closer to that target before you have to pay another month for the evaluation fee of the funded account. And when I look back at my back testing, when I went for 2 RR, when I compared it to just going for 1 RR, the profits were pretty much the same. There was very little difference. And so for my psychology, it was just better to go for 1 RR. But if you prefer to make those bigger profits and hope that you get a few trades in a row hitting 2 RR, which is possible, which I saw on my back testing, that is a great feeling. But for me, 1 RR is optimal, and that's all I need to pass funded accounts and get paid out. So why change? So once you've got that closure, you then target 1 RR. So here you can see we just closed below, and with that, put stops above the highs of the liquidity grab, because we believe that price will not Now we've had the liquidity grab, price will not return back to this level. And then I target 1 RR. And as you can see, price played out perfectly. We entered at 3:25 PM and we were out by 6:10 or 6:40, depending on when your alert's triggered. And when price hit my TP, hit this alert, I knew that I'd hit my TP and made another $300-400. Here's the proof. Take a look at these funded account payouts. This strategy has been a huge part of my success. So that's it. A simple 3-rule strategy that's been working for me. If you want full transparency, I'm uploading all of my trades, wins and losses on my trading journal, which you can find in the description. I also share them on my shorts for anyone who wants to follow along. Remember, trading psychology is everything. Once you get your strategy dialed in and backed by solid backtesting, you'll start seeing how powerful it can be. So stop over trading, trust your setup, and let the trades come to you. Thanks for watching, guys. Don't forget to like, subscribe, and hit that notification bell so you never miss an update. I'll see you in the next video. Take care. Good luck with your trading.